Hey, well, thank you everybody for joining us. We are going to learn about probably the only innovation that's come to private equity in the last 20 years that I've come across. Other than pricing's gone, down for yields, I guess, on things. But how capital is raised, how funds come together, and how private equity deals happen are changing and they're growing. And so we appreciate you guys having an interest in this topic. And we've got really kind of the two experts that I did kind of think who would be able to speak to this best. Stephanie will tell you her background. I think she does a great job kind of representing the investor community and the overall deal community. And then John really focusing on the sponsors themselves. I'm just a lender. We show up in these deals, write some loans to them, occasionally buy some.
There's no thing as just a lender. We have to have the money to close the deal. So
Well,
nothing
somebody's
is
got to.
just a lender.
But it's without the practitioners, we've got nothing to do. So I appreciate you guys being here with us. Stephanie, I might ask you to give your background introduction. Tell us more about.
Sure. Absolutely. I'm delighted to be here in Buffalo. As Shelby said, I head up the Independent Sponsor Forum for the Small Business Investor Alliance. We launched it 2 years ago, really recognizing the growth that's happening in this space. As you said, one of the last and only innovations in private equity. And we'll talk about what that is because I know that there are a lot of questions. We're really here to, we have a mission. We're kind of like the Upstate Capital Association. We are an association and an industry association to really elevate the brand and success of the independent sponsor as an asset class in the lower middle market. We're based in Washington, D.C., but if I have to be honest, I'm actually from Philadelphia. Go Birds. I'm really disappointed because I was hoping to come here today with the Eagles and the Bills being the only 2 undefeated teams in the NFL, and we both lost to really bad teams, so I apologize, but uh the Chiefs lost last night, so that we have that to, like, really be excited about. Um so I also lead membership for the SBIA and really, which is a small business investor alliance. Our goal is to really build an ecosystem for lower middle market investors that is incredibly efficient and effective. And the independent sponsors, as well as our lender friends and our private equity friends, are all members of that. And I think we can touch on kind of how that impacts lower middle market businesses as well. So, John.
Thank you. And Stephanie's being humble as she and her organization put on a creative set of sort of regional events, Chicago, Nashville, Philly, LA. So as you grow and develop as an I sponsor, go to her website, consider, going to one of those events. Are fabulous. So John Keppel, so I'm a partner and head of the private equity and independent sponsor practice group at a law firm called Lips Matthias here in Buffalo. I've been in this space since I was a little pup first year attorney at a different firm. This is going back September 1998 when the first deal I worked on, there was a group of guys who spun out. Some of the folks in the room may know this name called Gold Dome Bank, predecessor to M&T, and we're doing fundless sponsor deals. There were no conferences, there were no upstate capital events, right? It was three or four guys buying a business with, the high net worth family in town backing them and very simple waterfalls, hey, let's how about I get my money back plus an 8% pref and we go 50-50 after that, right? So I sort of cut my teeth as a young lawyer working on those deals and now we have conferences and fabulous ecosystems that support them. So we're excited to talk the next 40-45 minutes about what's going on in the space.
Excellent. Well, we've got some slides. Maybe we can, maybe before we hit the slides, John, let me sort of start with a level set sort of definition. What do you consider an independent sponsor?
Yeah, it's a great question, and I often think of the space in sort of three, way off on the one side. Some of you may have heard the term searcher or search fund, and then I think independent sponsor, and then I think sort of committed fund, right? So on the one extreme, when I if somebody says to me, "Hey, I'm a searcher or search fund," I think of someone who's buying a small plumbing business, getting an SBA loan, right, and is really buying themselves a job, not looking for a broader roll up. Probably not gonna talk to David or some of his friends in the space about capital, right? That's one extreme. The other extreme is a committed private equity fund. Some of you may know the name in town, Summer Street Capital, right? A fund that has capital under management from investors and typically is focused a little more up markets for larger deals. I think an I sponsor is sort of one of either two general types. One is somebody who was in private equity, investment consulting, leaves that to start their own firm making investment, or somebody who was in industry. maybe in an executive or an operating partner role and knows a particular space, and either individually with someone else is going to go buy one or more companies, independent, not typically tied to the same investors in every deal. So the term independent sponsor really drives to, hey, I can do deal A, I'm going to do with David with your firm. I can do deal B with another firm, right? So independent that they're not tied necessarily to the same investors. Oh, I will tell you, we're closing a deal now. It's the first time this firm is using us as counsel. It's their third deal. They're using the same investor on their third deal they used in their first year. Now they had a really, really compelling offer from another new firm, but they chose the comfort of the firm they had worked with before. So independent as in they don't have to go to the same investors, but are open to.
So it kind of speaks to how they're raising their capital and ultimately deploying that capital.
Correct.
Yeah, I think of it as just-in-time capital, right? Right, you don't raise the capital until you need it, and I think that there's some advantages and disadvantages to that as we'll get into, it keeps them independent of that 10-year committed fund that I think can be a challenge for private equity firms.
And each deal is typically, we were talking about this before the panel started, each deal is typically independent of another in terms of books or records, bank accounts, waterfalls. So God forbid one deal doesn't do well. It's not like traditional fund model where there's clawbacks and all that good stuff. So
Right. Well, and maybe this is a good time to talk about how this market has grown, and we can sort of set that against some of the other models out there. Let's see which one this is. This is the one I wanted to see. This is the chart that goes up and to the right, Stephanie. Volume is about how big is this for? Nope.
We always like charts that go up and to the right? Is there we don't want to look at any other ones. There's two. I can't turn around and see that, so I have it here. There's two data points on this, and look, I don't think that the numbers are exactly correct because this is a private market, and as we said, a lot of these deals kind of fly under the radar. But I think directionally, it's accurate. So you're looking at the orange line, which is the number of deals, right, starting from like 250 deals in 2019 to almost 800 in 2024. Again, directional, but what you see then is the value of all of those deals in the blue line. And that is pretty remarkable, right? A 7.5 time growth from 2019 to 2024. And I think what it also indicates is that the deal size is actually bumping up, which is, I think, the next slide, which is that. Yeah.
And I will say this, this is in light of a market where PE in general has slowed down to been flat at best in 2024. So I think about the independent sponsor crowd as not displacing, but they're somewhat secular from some of the broader trends in private equity. Financing is different, the capital is different, and the expectations can be different.
and we're going to talk during this panel about the pros and cons of the model, right? I think both of you just nailed the biggest pro, which is really a traditional committed fund has a mandate. We're going to go buy consumer product companies of this size, right? The traditional end sponsor doesn't. Now, they may have certain areas they proclaim to specialize in, but they're free to go buy a small company. I mean, I've got a client this year who's going to close their third deal. First deal was 12 million, did it on their own with a lender. Second deal was 25 million, did it with a firm called Plexus. Uh, we're under LOI for a $147 million transaction. And then the next one after this is like 10 million, right? And and every deal is structured a little differently in the waterfall, whatever. So there's no right or wrong answer about, size and who comes in.
Right. And Stephanie, you were wanting to talk about the average deal size. Uh, uh, that's in the places you're.
Yeah.
Yeah. This is
Yes.
huge.
Yeah, so this is really bumped up remarkably from 2019, and I think it speaks to the kind of professionalization of this asset class. And I think they're stepping up in the market, and we can talk a little bit about this in the discussion. But we've got maybe small funds. Maybe you had $150 million fund, and maybe they've raised another fund, right? And their fund is now whatever 500 million. And then you've got some of the smaller funds who were not able to raise another fund. And so independent sponsors are starting to step into that part of the market. And then hence you see these larger deals. And I think this is a secular change. They're going to remain kind of in ownership of that part of the market. They're more efficient in this space. So I think we're going to continue to see them hold this ground in the lower middle market and become a standard part of the M&A world.
And I think what's changed, David and stuff, we've all seen it in the last, I've been in the space for a while. If you had said to me certainly 10 years ago, maybe even 5 years ago, I think there was a negative connotation that, oh, it's a glorified finder. Someone found a deal and they want more than a point or two, for tossing a deal to someone, right? Now, and I'm not saying you go to Stephanie's conference, and although you guys do a good job batting at some other conferences, there certainly are some folks who fall in that bucket, but the vast majority are much more sophisticated, could easily be in private equity or working for a independent investment banking firm. So way more sophistication now than there's been.
Yeah, a meaningful refinement in what we see. You're right. 10, even 20 years ago, the fundless sponsor was kind of a bad word. Where's the money coming from? You got
Absolutely.
yeah, but what's happened is it. I think it became clear that the middle market and lower end of the middle market was not being served by traditional what we call middle market PE. Middle market PE wants 100 million and up, 9-digit size deals. This is growing like crazy. It's still only $64 million average deal size. So it sounds like a lot of money. It's still squarely lower middle market, and it's like it's filled out a lot of the activity that just wasn't getting attention in the past. That's why I think we're staying stable to up in the lower middle market.
It's the sophistication of the sponsors, and quite frankly, I think the SBI, we still see some deals with sort of your traditional, sort of senior mezz structure with some equity. We're seeing more and more deals, if I look at the deals that have closed far this year, I want to say 75 to 80% of them had SBICs in them, right? And they'll have a senior lender for, a piece of the debt or the revolver or the line or whatnot. But I mean, it's funny that we all have, for any of the other lawyers in the room, we all have Canadian lawyers who are friends and we work with on projects. They would love to have our ecosystem, right? And they're 5 to 10 years behind us because they don't have the SBICs, which is in that 25 to 50, 25 to $75 million enterprise value range. They are a great solution. They are a great solution.
We're seeing folks come in from London as well, right? London and Canada are maybe 5 years behind us. I'm not sure where everyone else is, but there's a lot of interest in this model.
And for those who don't know, SBIC's small business investment company, where basically the government is really encouraging right investment in small businesses, right? And funds like David can raise capital, get effectively matching money on that capital. So it lets and the beauty of an SBIC is they typically can do most of the debt and a good chunk of the equity as well. So if I'm an I sponsor and I go meet with David or another firm, it's more or less a one-stop shop, right? And that's pretty compelling.
Well, I think we saw the Diorio story just before this was that exact profile, right? Tim and Mike run an SBIC out of Albany. They came in as the institutional capital. There was an independent sponsor, there was a management team, and a great story. And I think that the SBICs are there. We're hungry for activity. We're raising money ourselves because the banks are feeding us. You've got to find those good deals, and more so than a finder, these independent sponsors are turning up with relationships with these sellers, doing the hard work, focusing, allowing us to be generalists while they spend the time being specialists. I think this is a slide I skipped over earlier. I apologize, I skipped over this earlier, but this kind of highlights how important SPICs are to this world. But also there are other institutional funds that are showing up in this. It's not just high net worths anymore.
Yeah, there's such an ecosystem now that is the backing. So a common question that I get asked as a deal lawyer is, "Hey, John, if I find a company, I get a company under LOI, letter of intent, to buy it, can I find the capital?" And my response is, if it's a really good company in a good space, you have someone on your team or you're partnering with an operating partner advisor who knows the space, and you're buying it right. You're not overpaying for it. You're buying at a fair price, maybe even a slight discount, but a fair market price. This whole group here will tell you who's backing these deals. So certainly family offices have stepped up. Um, I had a $25 million deal close early this year, and we had two or three family offices co-invest, take all the equity, and then we had a traditional lender take the debt, right? High net worths, a lot of you are familiar. As soon as you hear the term club model, a bunch of investors are going to sort of club together to help do a deal. So we see that in some of these smaller deals, we've had clients who really club the capital on their own and don't need any institutional capital, or, hey, I need 10 million of equity of this deal. David's firm is going to do 8, and then the sponsor and their friends and family will do 2, right? So kind of a club model, SBICs, and then sort of other groups kind of filling in the gap from there. So
And when we see those opportunities to come in with a chunky piece of the equity, it also lets us have a little more of a say in the deal, right? If you're one of 10 investors, you're not going to get to say a lot. But if you're speaking for 8 or 10 million, you can help drive and shape the process. Still give the independent sponsor what he's looking for, what she's looking for, but also give us the opportunity to have some say in it with respect to that equity bet. That time, some groups like a Plexus, we know them well. They like to come in and bear hug the deal. They'll do everything in it. We like to bear hug the debt and a little bit of the equity. Yeah. Each SBIC has a different risk profile. And as you go through that process of talking to SBICs or other investors, you find that could be helpful to steer who you're talking to based on what your goals are. So, John, why would a sponsor, why would a manager, that you can raise a fund or you can do the independent sponsor model these days? What's the reason one would go one or the other, and or what's the downside to being that sponsor as a manager?
Yeah, no, it's a great question, and I'll use the analogy of a specific client of ours. So, a gentleman who was a principal at a pretty large fund, at large as in 4 billion under management. So it's a pretty large buyout fund. He was an MD there, so nice salary, carry. He left that firm to start his own independent sponsor. Okay. And for now, he's sticking to that deal by deal model. At some point, maybe he raises his own fund. You say, well, why would someone like that? He's certainly making a good income, right? He's got some upside. He didn't like where the mid to higher end of the traditional market was going, where he's like, John, our firm X, we're one of, 10, 15, $20 million EBITDA business. A big investment bank has it under mandate. There's 32 bids. We're number 32. We're the quote winning bidder. He's like, what did we win? We obviously paid a lot for that asset, right? And everything's got to go exactly right. When I see all of these 3 to 5, $5 to $10 million EBITDA businesses, when I know I could grow those and add value and build the team around it, right? So I think the flexibility of sort of controlling your destiny, the freedom to make decisions and do what you want to do when I see clients, people go into it, it's that. I think the downside is I always tell a new and a sponsor is the first question people ask is, oh, do I need to register it in this and that and the other? I'm like, no, there's the one thing you need more than anything is 2 years of runway, right? You need 2 years in your bank account and assume that there are stats out there. I think, what is it, 18, 19 months from when you launch to your first closed deal, right? That's a long time. And that's a lot of either deals you didn't win, deals you got her LOI that died, right? And you've got some carrying costs, right? So the negative is that until I close a deal. And the other negative is I'm an sponsor and I'm talking to a seller. I've got to convince you I can get this done. Now, sometimes I can get a comfort letter, right? Maybe I've previewed the deal with David or someone's from like David. He'll give me now it's a conditional letter, right? But hey, we've talked about Acme widgets, and should this go under LOI, we're going to back Acme, right? And that can sometimes add some sort of street cred to the LOI. But convincing the seller and or the seller's advisors that you can get it done because everyone knows the process of an LOI is when that's signed up, typically for 60, 90, 120 days, that seller can't talk to anyone else. So their number one fear as a seller is, can you get it done? Can you close, right? So that can be a challenge in sometimes.
Certainty to close. That's key. But Stephanie, that's probably gotten better as the underlying investors have
Yeah.
developed and become more sophisticated, right?
Absolutely. I mean, as you can see from, these up and to the right charts, the capital flows coming into this market are pretty remarkable. And, we talked a little bit about the drivers, right? Why are we seeing this growth right now? And I think that there's probably 12 to 14 things at play, but I think that the three biggest drivers are talent, capital, and targets. And by talent, I mean, we've got a lot of private equity investors who, vice presidents, principals at private equity firms, even senior associates. And a few things are happening. We have founders who've been there for a long time. So, the ceiling is pretty hard, right? And they're working pretty hard and they see an opportunity to get better deal economics elsewhere. But I think more recently, in the last few years, we've seen fewer distributions back to limited partners, which means also that bonus compensation, that carry that's going to those folks is also getting reduced, which is really kind of opening up people's eyes to this other opportunity, which I think has a faster return. Um, right? If you do it well, you can capture your carry a lot faster than you can elsewhere. And I do think you need, when we run an independent sponsor boot camp for folks who are thinking about it, right? Because it is really hard. And we always say you do need 18 to 24 months. You need a supportive spouse. Really, you need a supportive spouse who's like, okay, you can give up that big paycheck for this. Um, we're also seeing a lot of, and you alluded to this, PE backed executives who are coming into the space, right? Folks, because there's been so much private equity capital out there for so long, we have a whole cohort of CEOs and CFOs who have been private equity backed 4, 5, 6 times. And I think historically their path was, oh, let me go be an operating partner and then I'll be a board director. And now I think they see the opportunity to actually have this entrepreneurial spirit and to get out there and grow companies on their own and them having the biggest say and the biggest bite of the apple.
And it's funny you mentioned the executives because I think that's another. If you'd asked me to go back 5 or 10 years, what are we seeing now more today? We still see some generalists or some firms that say, "Hey, we focus on these 3 or 4 verticals." We have a number of clients who we're going to go by early childhood education centers, full stop. We're going to go by alarm and security businesses in the tri-state area, full stop. Like very narrow niches. They know their niche. They've got a background and pedigree it. They have a track record, and that's pretty compelling because then when they go to the investors to say, "Here's what I did before, I'm going to go do it again," right?
It's hard to sometimes you're trying to back these people, you've never met them before, right? And they're like 30 days, 90 days from now, we're going to close. And I've got to get you comfortable that I can run a franchisee of burger restaurants. Well, if you've got that experience, if you've got that intentionality about it, you're right. Generalists are harder to support than someone that can express a solid industry path.
And I think, these folks also have a greater ability to land a proprietary deal to convince, right, a founder or a CEO that, they can help with the legacy of this business to grow the business and to take care of the employees, right? I think they can be a very powerful, credible, independent sponsor. So that's one. I think, on the capital side, pulling back on that thread, since limited partners, right, the folks, the pensions, endowments, foundations, family offices that give private equity money for, a nice return in the end because they're not getting the distributions that they have expected, they are also, I think, a little cautious about the 10-year lockup of a committed private equity fund. And so they are looking for other avenues to get a faster return on their investment. So, as you indicated, right, the private equity commitment is a blind pool, right? I'm giving money to John for 10 years, and he says, this is my general thesis, but I have no say. I'm a limited partner. I have no say in how really that gets done. And it's very different in an independent sponsor deal.
Yeah, and it varies by your investor, but most SBICs that go into an in-sponsor deal are going to have what's called a put right, meaning they can put their equity at some point. It's a negotiable. David's going to start at 5 years. I sponsor. I'm going to counter at 7. We're going to end up at 6, right? But at some point, David wants to know, like, I don't want to be in this thing for 10 or 15 years. You know what I mean? Let's scale this. Let's get out, right? So the put right is something you, depending on who your investor is, appears in a number of these deals.
So right, the capital is there. We've got a lot of middle market private equity firms, with interest rates rising, that the dynamics are changing, a lot of uncertainty. You see them dipping down into the lower middle market and thinking about independent sponsors almost as a way to help deploy capital and source deals. Although they've got to pay those full economics.
A lot of these larger funds now. So we have a client who's focused on acquiring patents and IP, right? And there's an $800 million fund that has lobbed off 20% of their fund and dedicated it to our clients.
Deal management, portfolio management, because
That's
you end up, the sponsor manages that deal on your behalf. You could probably do more deals
100%.
in a book because you're not having to actually do all the work.
Absolutely. And I think, we of course have family offices coming into this space, but ultimately, I think SBICs really legitimize this market
Mhm.
by being kind of the first group that really backed independent sponsors. And I think, you see it in the numbers. SBICs are great partners and have really given a lot of gas to them in this market. And I think finally, right, the number of targets in the lower middle market is just astronomical. It's very target rich. You've got this historical, generational transfer of wealth. I don't know about your kids, but if I had a business, they'd be like, no thanks. Um, Right? It's just not what folks want to do. And so there are a lot of opportunities out there of business owners who might be ready to step away, but want to ensure that this legacy continues, or they're looking for an opportunity to grow their business and looking for this outside capital. So it's kind of the perfect storm, but I think a lot of these will be secular ultimately and not cyclical changes in the market.
Your comment about the sort of the velocity of getting your money out from the LP's perspective, I often bemoan that, well, the independent sponsor's trying to get his money out quicker. The rest of us are stuck in these funds for a long time. But you're not wrong about that. If the funds themselves, if the institutional investors themselves can participate in that, they can short circuit this pooling issue that portfolio funds
I
have.
mean, listen, the IA sponsors are everyone's motivated to scale the business as quickly as possible and have an exit, right? We all know there's two forms of growth. You hear the terms organic growth, meaning I'm going to add sales resources, marketing, that type of thing. And then there's sort of strategic, where I'm going to go the traditional private equity model. I'm going to buy a $3 million EBITDA business. And I'm going to go acquire, half a dozen $1 million EBITDA businesses, hopefully at lower multiples, right? So when I arbitrage all together, I get north of 5, north of 10 of EBITDA. You're seeing this happen in the accounting space, right? And you name the industry, it's happening, right? So and then you layer on top of the availability of capital, and then we could easily spend 45 minutes talking about something called QSBS, Qualified Small Business Stock, which some of you in the venture community know, but also applies to many of these deals where you can buy a company, hold it for 5 years, and potentially have no federal or state capital gains tax, right? And the recent tax law changes in July actually made that even a little bit more attractive, right? So there's a lot of, between the capital, the tax laws, right? The talent, there's a lot of things just pushing this more and more. And there's a lot of sophisticated advisors, accounting, lawyers, HR. We've got some rep and warranty insurance friends in the audience, right? There's a whole ecosystem of folks that know these deals and know them well, that if I were to go back 5 or 10 years ago, yeah, there were some, but not as many as today.
Yeah, you wouldn't recognize an independent sponsor deal from 2025 as compared to one from 2005 or 2015. Completely different.
You never would have believed that this market would look like this. If we told any of us this 3 or 4 years ago,
Right.
maybe you knew.
And some of
Maybe he
Yeah, he did.
maybe he knew. I didn't know.
and some of the bigger deals, depending upon who the partner is and what they're willing to underwrite, if I gave you the stack of quality of earnings, HR report, voice of the customer, you'd say that's no different than a PE deal, right? Now, maybe on a small 10, $15 million deal, you don't have the budget to do some of that stuff or all of it, right? But some of the sophistication on these larger transactions, just the only difference is it's not a committed fund. That's really it. So.
Well, so Stephanie, when you talk about the SBICs, you're close to this. What proportion of our activity do you think is in the independent sponsor world these days inside of SBIC land? Have we done that
That
math yet? Has SBIA done that math yet?
Well, so we're actually just we put our feet on the path of doing independent sponsor performance return study because, as we know, this industry likes math, right? And so we talk a lot about um, how these deals outperform their peers, but we don't actually have the data. So we are working on that, and I think we could probably back into it. I only know 2 SBICs who are not doing independent sponsor deals right now. I think it's a great partnership, not only for the independent sponsor. I think, SBICs lead with debt, but they think like equity investors.
Right.
So, if you just have a lender in the deal, their tolerance for anything going sideways is going to be really narrow. And I think, SBICs have the ability to step in. You have some of that expertise. And so that patience, I think, is appreciated. But at the same time, I think it's great for SBICs because I think it actually puts you a little higher up in the capital stack if, some of you guys are writing the whole check,
Right.
and it gives you more control on the back end of the deal and the ability to potentially help select the investment banker who's going to sell the deal. So I think it really works well for both of you, but I think almost all the SBICs, with the exception of just a few, and I think they're gonna change their minds.
Yeah, and I think the only it comes a little bit of challenge on the independent sponsor side. I think there are some SBICs who, if you this is your first deal, they just won't back it. They have a rule: I don't back a first time in the sponsor, and that's it's hard to get away from that, right? Until you closed your first deal, because oftentimes it's rare that two or three people are spinning out a private equity or investment banking together. It's you know. David spun out of private equity, Stephanie spun out of investment banking, I spun out of law, whatever it might be. We came together, this is our new firm. Everyone's like, well, each of the three of you have done deals in the past and have somewhat of track record, but you haven't really worked together, right? And how's that going to work out? So there's that dynamic. I think it can be a little tricky in some of these deals, and it drives some random bouncers crazy. Like the check size, there are some groups like, well, I'll do 15 to 20, and so oftentimes. I only need 5 or 10. Well, it's too small for a lot of groups. Or I need 40. Well, then maybe two groups come together. So trying to, David loves these four industries, but he'll never touch these other four. So a lot of it is try to triangulate who's the right check size and the right industry that will do something like this. And, it varies by industry. If a deal closing, knock on wood, later this week, our client got 6 term sheets from SBICs. Very attractive deal, priced right. And I mean, that's great. In today's market, to get 6 term sheets is phenomenal. There are other deals where you get 1 or 2. And the ones that you get 1 are the worst because you have to pretend like you've got more than one. David, let me push back to your. I've been looking at all the term sheets on my desk. Oh, it's just yours. So, but so you try to use that leverage when you're on the I sponsor side to negotiate better terms.
Have you ever done a first time have you ever supported a first time independent sponsor?
We have.
Yeah,
Yeah.
I find a lot of SBICs do, and sometimes it's their best deal.
And my horror story about an independent sponsor that I won't share was not a first timer. And he came recommended and everything was fine. And all the things that I would think would check the boxes that we're looking for today, that one so I'm not sure there's been enough, maybe we're still in early days where we haven't had the full refinement of final terms and the way these relationships work. And maybe that's a good segue. What is the basic economic deal in an independent sponsor arrangement? What does the sponsor get? What does the funder get?
Yep. So it's basically from the end sponsor side, there's sort of three key economics. So one is what's called a closing fee, often plus or minus 2% of enterprise value. Okay. And let's say it's a $30 million deal. So 2% would be $600,000. Typically, all or most of that fee is rolled into equity in the deal. Okay. So there's a closing fee. After the deal closes, there's something called an advisory fee or a management fee. It's typically 5% of EBITDA, or that's negotiable. Sometimes on a smaller deal, you might say, with all due respect, 5%, that's just not enough. The resources this company needs, right? So that's a negotiation with your investors. And then the third piece, which is really why everyone's even in the deal, is what's called the carried interest or the promote, meaning, okay, great. So David's firm is going to back the deal. I've got to return his equity plus a hurdle, oftentimes like an 8% pref. And there'll be some sort of waterfall that how do we split the profits after that? And that's very, very negotiated and bespoke, right? Depending upon the attractiveness of the deal and the I sponsor. Is it, after David gets, 1.5 or 2 times his capital back, we go 80/20. There are things what's called a super promote or super carry at like 25 or 30% the sponsor. So very, very negotiated. There's general industry norms, um, but a wild range depending upon leverage and a whole host of factors.
And what about control or governance features? If someone's coming in, say we speak for all the equity that an independent sponsor raises, how important should I feel? Should I own the majority of the business?
It's called the golden rule. He who brings the gold makes the rules.
Okay.
So usually if an institutional so if we were on the independent sponsor side and we knew an institution was absent our rolled fee, was pretty much covering all the equity, that firm is gonna more or less cover the shots. Now depending on the firm, you may say, hey, I don't want to control the board, but these are all the things that you can't do without my consent. You can't refi the business, you can't sell it, you can't do an acquisition right. The other dynamic we sometimes see, which is, and often see this with independent sponsors who have already gotten a few deals under their belt, is they may either so I've had a couple deals this year where maybe an SBIC provided a half to two-thirds of the equity, and through a family office or friends and family, they were able to bring meaningful equity to the table. So generally speaking, the more diverse the equity group, so that one deal I mentioned earlier this year, the client needed 10 million of equity. We got it from three family offices. Our client controlled that deal, controlled the board. We had a representative of the 5-person board. We had a family office representative on the board, right? So it varies greatly by deal, but generally speaking, if I'm getting one institutional investor who's covering pretty much all the capital, you know, I'm just genuflecting and saying, "Thank you, may I have another?" Yes.
We try to like balance that. We want them to be able to raise capital because we're not sure our vote is the right vote. So if we say, all right, we'll do third, a half of it, but you got to show up with the other half. And so I think what we concede for that is we won't end up with control, but we might have some negative controls. We helped anchor his capital raise or capital raise, and so we might get to say, well, you can't do this, you can't do that.
And in a perfect world, we try to encourage our clients, if you can find that type of solution. It's not ideal to have, as much as one-stop shop makes for efficiency, right? To have two or three key investors at the table is good because, and who knows, in a year or two, one of the investors shuts down or wants out of the space or whatever, to have other meaningful folks around the table is pretty helpful.
And Stephanie, you represent through SBA, the SBIC is doing this, but within those deals, the level of sophistication of the other investors, are we seeing interest in ISF outside of the SBICs?
Oh,
Should we make
absolutely.
up the ISF
Yeah.
conferences that aren't SBICs?
And look, I think the Independent Sponsor Forum is driving growth in the Small Business Investor Alliance. And so we are seeing a lot of family offices who are interested in this space. And, you know, I think there are maybe 30 family offices who are pretty consistent about independent sponsor deals. Maybe it's more than that. There are a lot of tourists,
Yes.
right, who hear about this and these better returns, but I think they're really hard deals to do. Um, Limited partners, traditional limited partners, some small pension funds where you got police and fire, some small family, some small endowments and foundations who are showing up and very interested in this space, and a few who've been doing it pretty regularly. And so, of course, we see the some private equity firms who are new to the space, and those are some of the control private equity firms who are coming down market. And I think they're good partners for folks with operating expertise who really don't know how to run the deal. So I think as an independent sponsor, and if you're thinking about right selling your business and bringing in an independent sponsor, you always have to think about that the value balance, right? What did they bring to the table that you need, and vice versa? And so with a controlled private equity firm, they've got that transactional expertise. And if you've got someone who is a PE-backed executive, they know how to grow a business and they know how to understand an industry, and that's a great pair. But you're not going to get someone with transactional expertise who wants a control private equity firm.
And generally speaking, I agree with what Stephanie just said, that the SBICs are more well known, or at these conferences. You can go to, their website, see what they've done. The family offices tend to be a little bit more discreet, and some of them intentionally won't go to SBIA, won't go to iGlobal, because they don't really, you kind of have to like know someone who knows someone and get a meeting, and there's no website, and there's no like, this is our portfolio and criteria, right? They intentionally are very, very under the radar, right? So they're a little harder to find. But they are, I mean, you saw the stats up here. They're doing a fair number of the deals.
Speaking as a lender to these kinds of deals, I like it when it's a little harder for them to raise the capital because that means that there's been some real scrutiny on it. Not just someone that's passed the hat for a bunch of $50,000 bites, but you convince someone to write four people to write a $500,000 or $5 million checks a piece. Those are it's not the same as convincing LPs to capitalize a fund, but it is a heavy lift that's hard to do. And if you can show that you can do that, then it lets everybody else in the capital structure feel more comfortable that we're all doing a good deal together. Um, so, any questions, guys? We apologize. We rambled ourselves a lot, but anybody have anything they'd like us to address or any questions before we get kicked off? It's like my LP meetings. No one ever wants to ask questions. Karen.
Hi, Karen Gregory with Blue Highway Capital. Hi, Stephanie. Nice to see you. Um, Maybe we think about it wrong, but we haven't liked the independent sponsor model. We have been very opposed to looking at those deals, in particular because and maybe the wrong independent sponsors have come to us, but we've wanted to see not only a track record, but also some domain expertise. But the third thing is we've wanted to see skin in the game. We don't want them to just come to us and say, "We need $10 million, please write us a check." Are we thinking about that wrong? I'm just
It's
asking the question.
no, I could take a first crack. It's a fair question, and it comes up in a lot of deals, right? So let's assume the sponsor has a bit of a track record, has some domain expertise, right? And has a nice deal under LOI. There are a number of groups that have a minimum equity amount, whether it's a percentage or a dollar amount that they want to see the independent sponsor, the principals fund themselves. Some groups will say, well, I'll count, sort of friends and family money toward your piece. And the argument is that, you'll be less inclined to do wrong by your family or your close friends, right? So, but there's another big group out there called TCOM, which is based in Pittsburgh. I know for sure they require, a decent equity stake to come from the I sponsor. Now, the challenge on the I sponsor side, especially for a newer one, is a lot of times they don't have much to put in the deal, right? They've left a firm, they're kind of covering their overhead, that type of thing. So they're in a bit of a pinch, right? So there's just maybe some groups where the group likes the deal and likes them, but they don't have that equity check to put into the deal, right? It's a dynamic that certainly shows up in some deals. I'm not going to say it doesn't.
Karen is a longtime independent sponsor skeptic and one who's lately become quite converted. It's half of the last 10 deals we've done. There's so many out there that if you set your standards and decide what it is that does matter to you, I think you can find them. And so if you set those requirements, keep looking because they're out there. What is the case is they're coming to dominate the lower end of the middle market in a lot of ways, and they're taking business from funded sponsors who themselves are spending more time up market because the bigger the funds, the more management fees you get.
And sometimes you hear the term, the SBIC or the capital market wants to see them invest an amount that's meaningful to them. And that could be different for everybody, right? That could be different for everybody, for sure.
So one of the things that we're trying to do, recognizing that I think the capital providers and independent sponsors match up very specifically based on criteria, just as you mentioned. Like we are looking for someone who has deep domain or industry expertise and has done at least 4 deals. Um, we are collecting all of that data. We're kind of following 2,000 independent sponsors right now. We've probably vetted 1,400 of them. I think 8 or 900 of them are real, like they've actually, closed some deals or they're backable. But we actually are collecting their background information. So why are they backable, right? Were they an industry expert? Did they run corporate M&A for a multinational company? Were they P-backed executive? What is their investment thesis? So we actually have that information available to you as a member of SBIA because we realize that that's how folks match up, right? If we can get you better data, you can have better meetings and that will yield closed deals, right? It's just more time efficient for everybody. So we're looking to continue to develop data that is useful for the whole industry.
Okay.
I'm glad.
We have time for one more quick one.
All right. Mark, I saw you raising the hand right there.
So generally speaking, no, right? Yeah, there's always regulations that come into play when you raise capital. It's usually called like a private offering, right? So there's certain disclosure requirements. You may have to make certain notice filings at the federal or the state levels. That you might have heard the term like blue sky filing, that type of thing. But generally speaking, if you maintain less than 150 million of assets under management, less than that number across all of your deals, you are not required to register as what's called an RIA, a registered investment advisor. And quite frankly, part of what we indirectly touched on is many firms, I know many close friends and folks who have been at larger committed private equity funds that are RIAs, and there's policies on what public stocks they can invest in, insider trading, and you have to, if you cough and go to the Sabres game tomorrow, you have to report that, right? So part of the advantage of the independent sponsor model, assuming you stay under that radar and threshold, is you're typically not required to register, and the regulatory burden is pretty low. I mean, you need a website, right? You need some qualifications. Not that high of a bar to form your own firm. So
Okay, well, everybody, thank you very much. Apologize for running a little bit long. We'll be here to talk further.
Yeah.